Be fearful when others are greedy, and greedy when others are fearful. Those were the enlightening words of Warren Buffett.
If you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time.
Hello and welcome back to Wealthy Mind. Before we dive in, make sure to click the like button, subscribe, and turn on the notifications. This 1-second action will really help us grow so we can bring more videos for your pleasure. Alright, let's get started. Known as the Oracle of Omaha for his investment prowess, Buffett has amassed a personal fortune in excess of $100 billion. According to Forbes, he inspires legions of loyal fans to make a yearly trek to Omaha for an opportunity to hear him speak at Berkshire's annual meeting. Warren Buffett once said that it is wise for investors to be fearful when others are greedy and greedy when others are fearful.
If you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time in all probability. People really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations, and more than that, do something based on small changes in quotations. But if you didn't, think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. If you buy a farm, do you get a quote next week? Do you get a quote next month? If you buy an apartment house, do you get a quote next week or month? No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. If they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more. Ben Graham wrote about it. It's been explained. But if you can't get yourself in that mental attitude, you're going to be scared whenever everybody else is scared. And expect somebody else to tell you when to buy and therefore get your courage back up or something. I could get this fellow's courage up substantially by saying it's a wonderful time to buy. And then a week from now, he'd run into somebody else that tells him the world is coming to an end. And he'd sell. He's a broker's friend.
This statement is somewhat of a contrarian view on stock markets and relates directly to the price of an asset. When others are greedy, prices typically boil over, and one should be cautious not to overpay for an asset that subsequently leads to an anemic return. When others are fearful, it may present a good value buying opportunity. As he said in the past, it is much better to buy a wonderful business at a good price than a good business at a wonderful price. Investors must be concerned about what the assets themselves produce for investors. That's what a logical mind thinks in investments, especially during market crashes. Take a look about what he had to say about Bitcoin and gold, for example.
When you buy a farm, you look at the crop every year and what prices are, and you decide whether it was a satisfactory investment. You look to the asset itself and what it produces for you. When we buy a business, we look at what the business earns and decide how we feel about it in terms of what we paid. But we are buying something that at the end of the period, we not only have what we bought in the first place, but we have something that the asset produced. And when you buy non-productive assets, all you're counting on is whether the next person is going to pay you more because they're even more excited about another next person coming along. But the asset itself is creating nothing. One of the interesting things, for example, is gold. If you go back to the time of Christ and you look at how many hours of labor you had to give up in order to buy an ounce of gold, and you take it forward to now, you'll find the compound rate maybe a tenth or 0.2%. And then you have to insure it during that time and make sure somebody doesn't steal it from you and everything. But it doesn't produce anything. And productive assets. You can pay too much for a productive asset, but I bought a farm in the 1980s, and every year look at how much it produced the way of soybeans and corn. And at the end of that period, I've still got the farm, and I've gotten some significant income off of it. Apartment house, operating business. But if you and I buy various cryptocurrencies, they're not going to multiply. They're not going to be a bunch of rabbits sitting there in front of us. They're just going to sit there. And I got to hope next time you get more excited after I bought it from you, and then maybe I'll get more excited and buy it from you. And actually, we could sit in the house by ourselves, and we could keep running up the price between the two of us. But at the end of the time, there's one Bitcoin sitting there, and now we got to find somebody else. And they come to an end. It's buying something because you expect the pool of people who want to buy it because they want to sell it to somebody else will grow. And it's wonderful because it does create a rising price, does create more buyers, and people think I've got to get in on this. And it's better if they don't understand it. That's the other thing about non-predictable. If you don't understand it, you get much more excited than if you understand it. I mean, if you buy a bond that says it's going to pay you 4% a year, you're not going to get any pleasant surprises. She's going to pay you 4% a year. But if you can have anything you want to imagine, if you just look at something and say that's magic, you can do it with shark's teeth or seashells or anything. And they did it with tulips in the 17th century in Amsterdam, and they'll do it again. I mean, people, they like to speculate. They like to gamble.
When the market crashed in 2020, Buffett waited for the second drop that nearly all past market crashes have. If never happened, he sold shares, but he didn't begin buying shares until June. Buffett still made several $billion. Like all smart investors, he views this as an opportunity to buy stocks at a discount. He made a lot of money in the 2008 crash by buying stocks before they went back up again.
When we buy a stock, we would be happy with that stock if they told us the market was going to close for a couple of years. We look to the business. It's exactly the same way as if you were going to buy a farm a few miles here outside of Omaha. You would not get a price on it every day, and you wouldn't ask, whether the yield was a little above expectation this year or down a little bit. You'd look at what the farm was going to produce over time. You'd look at the expected yields, you'd look at expected prices, the cost, taxes, the cost of fertilizer, and you would evaluate the intelligence of your purchase based on what the farm produced relative to your purchase price. Quotes would have nothing to do with it. That's exactly the way we look at stocks. We look at them as businesses. We make judgments about what the futures of those businesses will be, and if we're right about that in those judgments, the stocks will take care of themselves.
The reality is that a crash is so much better than a slow bleeding market. Market crashes, you pick up the pieces and move on. That's so much better than watching the markets tick down every day, not knowing where they will stop. Buffett also points out that he's not a fan of margin debts or loans used to buy stocks, especially during market crashes.
Yeah, if you would leveraged up investments in just common stocks, and you'd figured a way so that you would have staying power if there were any market dip. I mean, you'd obviously have obtained extraordinary returns. I pointed out in my investing lifetime, an index fund would do 11%. Well, imagine how you'd have done if you'd leveraged that up 50%, whatever the prevailing rates were over time. So a leveraged investment in a business is going to beat an unleveraged investment in a good business a good bit of the time. But as you point out, the covenants to protect debt holders has really deteriorated in the business. And of course, you've been in an up market for businesses, and you've got a period of low interest rates. So it's been a very good time for it. My personal opinion is if you take unleveraged returns against unleveraged common stocks, I do not think what is being purchased today and marketed today would work well. But if you can borrow money, you can buy assets that will yield 7 or 8%, and you can borrow enough money at 4 or 5%, and you don't have any covenants to meet, you're going to have some bankruptcies, but you're going to also have better results in many cases. It's not something that interests us at all. We are not going to leverage up Berkshire. If we'd leveraged up Berkshire, we'd have made a whole lot more money, obviously, over the years. But both Charlie and I probably have seen some more high IQ people, really extraordinarily high IQ people, destroyed by leverage. We saw long-term capital management where we had people who could do in their sleep math that we couldn't do, at least I couldn't do, working full-time at it during the day. I mean, really, really smart people working with their own money and with years and years of experience of what they were doing, and it all turned.
The big risk is that stocks are pledged as a collateral against these loans, and when the value of that collateral falls in a market plunge, borrowers face what are known as margin calls, forcing them to sell shares. This, in turn, sends prices yet lower, setting off additional rounds of margin calls followed by yet more selling.
Yeah, and when you commit the money, in the case of private equity often, they don't take the money, but you pay a fee on the money that you've committed. And of course, you really have to have that money to come up with it at any time. And of course, it makes their return look better if you sit there for a long time in treasury bills, which you have to hold because they can call you up and demand the money, and they don't count that. They count it in terms of getting a fee on it, but they don't count it in terms of what the so-called internal rate of return. It's not as good as it looks, and I really do think that when you have a group sitting as a state pension fund,
Warren, all they're doing is lying a little bit to make the money come in.
that sums it up.
It's very difficult to predict when the next stock market crash will be. In general, the stock markets can be volatile at any point of the day, month or year, and it is only after a long period of time or a significant drop in the market, at least 10% for example, that a collective acknowledgement can be made. It is tough for investors to predict stock market crashes and almost impossible to avoid them, as these have often happened throughout history.
We have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic even if the price was right.
All right, so you don't pay much attention to the dismal scientists then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But and I just don't know of any economist that actually has bought businesses successfully or done well in stocks. Paul Samuelson did. You may know he was a big shareholder of Berkshire, but it's they make guesses, and there's so many variables. I mean, in the hard sciences, you know that if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is, you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
So should you buy stocks when the market crashes? And what are your best investments during a stock market crash? Please join the discussion and let us know your opinion down in the comment section below. That's it for this video. Be sure to give us a thumbs up if you enjoyed it. Also, don't forget to subscribe to always catch our videos. We'll see you in the next one.